Welcome back. Well, markets in kind of flat terrain at this point in time, and that gives us a wonderful occasion to focus on some of the earnings that we got and some more long-lasting and long-term questions that confront Indian infrastructure sector. A company we have on our radar today is Punj Lloyd. The weakness in the financial performance did show up and continued in the second quarter. But for the moment, there was some positive news from Punj Lloyd. They just announced this morning winning an order of what is that, close to 800 crores?
660 crores. Yeah.
Okay, 660 crores. And we have with us Mr. J P Chalasani, Managing Director and Group CEO of Punj Lloyd. Good morning, Mr. Chalasani. Let me start with that good news. What is the order book looking like as of, say, year to date?
See, as we closed with the latest order what we got for these road projects, we are 24,000 crores plus order backlog what we have on today. But what is most important is this year we've been seeing good order book happening. We have in the pipeline and tankages sector quite a few orders which are outside the country. But this order importance is that this is the first major order we got in India. Most of the orders what we got till date in the current financial year have been outside India on this. I think the infrastructure sector in India is now picking up. In addition to the orders what we've won right now, there is about 20,000 crores worth of road bids which have been announced and due for bid in this month and the next month on this. And there are quite a few opportunities coming in the metro sector. So infrastructure is, I think, is really now opening up in India, and we expect to build the order booking there.
Okay. Mr. Chalasani, good morning and thank you for joining us. Despite having a very strong order book, as you just suggested, your revenues have been very weak this time around. I mean, total income has gone down by about 43%. Just take us through when you expect the revenue flow to pick up and what could be the growth trajectory, say, in the second half of the year or in the first part of FY16.
See, if you remember the last time when we had the first Q1 results, we gave a guidance that from now onwards, if you make Q1 results as a base and the quarter to quarter, you will see an improvement. And if you see that this quarter, the Q2, if you look at the Q1 comparison, our revenue has gone up by about 14%. And even the margin pressure is slightly coming down, where we had about minus 22% EBITDA margin last quarter, it came down to minus 7%. So we're improving. The reason for the revenue being low is that we are now transiting from the completion of the old projects to the new projects. And we didn't have a major order wins in the last couple of years. So therefore, you would always have that gap of the old projects tapering off and the new projects picking up on this. I think that's the reason what you're seeing the revenue being low. But then you will see quarter on quarter revenue picking up from now onwards. And once the new orders what we won, which we pick up in a significant way in the next financial year, the revenues would automatically grow. Our concentration is not mainly on the revenue, but right now our target is to improve the bottom line on this, because revenue would anyway will come because we have the large order backlog on this. So therefore, most important for us is to reduce our financing cost and reducing our overheads cost and improve the margins. Concentration is completely on the margin improvement.
Okay. Actually, I was going to come to that reduction of debt in a bit, but let me start with that. I want to come back to your order book and the quality of the order book once again. But since you spoke about improving your financing or reducing your financing costs, what's the plan? Any more non-core asset sales?
Yeah, as we mentioned last time, that the two tracks we're following for reduction of our debt. One is the non-core asset monetization, and the second is the aggressively following up our claims which are there globally, and which is a significant amount which is outstanding out there. On the non-core asset monetization, we talked about our stake sale in Medanta as well as the Bath sale, which there was a slight shift of a couple of months in the deal happening on this, but the deal is done now and the documentation portion has been done. We are now in the process for both.
For Barge and?
Now the money to be in should be sometime towards the end of Q3, that is, let's say end of December, we should get that money. So that would help us to reduce the debt. And we are seeing some momentum, some traction in our claims especially in the Middle East and other places. That we expect to materialize into cash in the Q4 of this year. So therefore, we should be on the track for what we gave the guidance that on March 31st that our debt would come down significantly.
So
how
can
much
you
is
give
the
us
claims,
some numbers of how much have you gotten for this sale of barges and Medanta?
I think I will be able to announce that amount sometime next time when we meet, because now it's an approval process. Till the documents are made it formal, I won't be in a position to exactly say the amount. And but it's an amount which is would have a significant impact on our debt reduction. That's what I can say.
And on the claims, can you give us what is almost getting settled and what might you reasonably expect by March?
See, some of the claim settlement with Qatar Petroleum and in Saudi Arabia, Satab, and then NDIA, New Delhi, the New Doha International Airport. These are things which have picked up momentum in the last 2 months. And we expect that the process to get concluded in this quarter, but then they have their own approval process. Therefore, I said that the money to flow in the Q4 of that. The same way in India, we are aggressively following up. As you know that the claims take a little longer than what we anticipate, but we're on the track. So therefore, something should flow in December, and most of it would flow in Q4.
Okay. And Mr. Chalasani, you can give us some indication of, how much your debt might come down by and how much your interest costs might come down by. So currently, with debt at about 6,000 crores, can we expect a 10% reduction, a 15% reduction by the end of next year? And also, I think 200 crores is your run rate of interest costs per quarter. How much do you think you can scale it down by in the next 1 year?
See, our target is to bring down the debt, as I said earlier, by about 40%. Not to 40%, by about 40%.
Okay.
We are right now, we are still on the track on this. Our guidance continues in the same manner on this.
Okay. So, how much can we reasonably expect the interest cost to come down by, you think?
Yeah, the debt comes down by 40%. Then obviously, to that extent, our financing cost should come down. Because that's very important for us. The reduction of the financing cost and reduction of overheads is the key for the company as we move ahead. And that's what we've been working on in the last 6 months. And we have achieved some extent of the overheads reduction. And we brought in lots of efficiencies in our operations. But then the debt reduction obviously depends upon the funds flow in, and which we don't have 100% control. There are other parties involved, which is what we're chasing. That's the goalpost moved by about a couple of months, but we're almost there now. It would happen.
Can we put, say, 2,000 crores to claims, money coming from claims in FY15?
See, as I said the last time, on paper we have a claims worth of about 10,000 crores on the globe. But then when we took stock internally, saying that let's see that what is the most conservative basis we can recover these claims, we arrived at a figure of about 3,000 crores. And we did a quarter-wise schedule, and then it is expected to be liquidated by Q3 of next year. Okay, so therefore we expect this in the 4 or 5 quarters, the money to flow in gradually. Yes. And these claims is something which we target each quarter, then it might move by the next quarter, but end date we're targeting is the Q3 of next year is what full money of 3,000 crores minimum on a conservative basis to be achieved.
If that 7,000 crore of claims have to be written off, will it have an impact on the P&L? Mr. Chalasani, you can hear me?
Okay, Mr. Chalasani, is our voice reaching you? Okay, I think there's some issue with the audio. We will just try and fix that in a bit. We'll get back to him, but just a look at the markets as well. Flat for now, but mid-caps are picking up with quite a bit of steam. So the mid-cap index itself is up about 0.6%, and Punj Lloyd too is up about 6%. Mr. Chalasani, if our voice is reaching you, Lata was asking you about the fact that if 7,000 crores has to be written off, then what will the impact be on the P&L?
No, it is not written off in the P&L because we're not even considered them in our P&L.
Okay.
So therefore, it doesn't make that difference.
Fair enough.
You were also replacing the Indian debt with foreign debt. Is there anything more in that you can eke out in terms of financing gains?
No, Lata, I think right now our concentration is mainly to reduce the debt on this.
All right.
Optimization of the debt is step number 2. So we want to concentrate one at a time on this. First reduce the debt, reach an optimal level, then start doing the debt optimization so that you can further reduce your interest costs.
Are there any other non-core assets apart from Medanta and Baj that you could be looking to sell?
There are a few, but right now these are the 2 big things which are concentrating on. If there need be, we will look at few others.
Okay. What are the others?
No, they are. I don't want to talk about them at this stage, but because we are also not even thinking about monetizing those assets.
Sure.
Because we feel that with these 2 plus the claims, and we would reach a very comfortable level in terms of thing. And with the new orders picking up, and these being the good orders with good margins on this, so therefore I think we'll be on track thereafter.
What about the order book that you were talking about? 24,000 crores is a very impressive number, Mr. Chalasani. But as you said, part of it are slow-moving orders. Can you give us some breakup in terms of those that are slow-moving orders, low-margin orders, which hopefully, as they fade out, your margins will improve? What percentage would you consider slow-moving and low-margin?
See, in this 24,000, let me tell you that about 8,000 crores is in our pipeline and tankages vertical, okay, which is extremely good, very competitive, very good margins, and we will still go ahead full blast on that. About 3,000 crores is what we have in our building and infrastructure division, both in India, that's the roads, metros and the things, India and outside India. That's again a good one. The only one which is slow moving in the entire basket of 24,000 crores is the orders what we have in Libya, which is about 7,000 crores of it, which are at standstill at this stage. And we are seeing some movement of late, but not significant, some movement. The client is asking us to start the work. In fact, our joint venture partner, who is a local partner, has commenced the work. So therefore, we will see that how that goes on, then we will also start the work. There is some little movement, but not significant. The slow moving, when I said, is that 7,000 crores in Libya, where I think by the next quarter end when we have this call, I hope that to see some traction happening there.
All right.
But right now that's a slow moving.
Okay. The FIPB has given you a go-ahead for, for the defense sector. What kind of opportunity do you see from the defense sector now for your company?
See, we have the large manufacturing base in the state of Madhya Pradesh, where we already been working for the defense public sectors as well as some defense companies outside, but that's pure manufacturing on this. But with this approval happening now, I think we're seeing significant opportunities in defense. Having said that, these defense opportunities to fructify into an actual order would take anywhere between in the cycle of 1.5 to 2 years on this. That's when the orders will fructify, and thereafter the delivery of the orders is anywhere between 2 to 3 years. Order size, I understand, is that varies anywhere from 500 crores to even up to 2,000 crores. We're participating, we're putting a couple of bids. Let's see when the bids get opened up on this. But the defense orders, though the opportunity is tremendous, but the starting would be a little longer time because the cycle itself is about a couple of years before they finalize the orders. But we are fully prepared to take advantage of the opportunities that are coming up.
Okay. What's the percentage of domestic and foreign orders, and are domestic orders margin-wise better? How much better?
See, right now we are still continuing in terms of, on the top line wise, we are still continuing with 2/3 coming from outside India and 1/3 in India on this. Our margins are better off as of now in outside India in the projects. Okay. There were much better efficiencies in implementing those projects. Okay. But moving ahead, I think some of the infrastructure projects what we're getting in India would have good margins. Like the road project what we announced today is a pretty good project from the margins point of view.
All right.
And these are all short duration projects like this. Today's project is 27 months execution.
Okay. All right, Mr. Chalasani, on that positive note, thank you very much for joining us with all those details about what's occupying Punj Lloyd's Brains Trust. Well, we have to take a break on that note. Joining us next to detail their earnings is Mr. P. Vijay Raghavan, the director at